This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 3 videos on trading in the middle and the end of the day. Most days have some kind of a transition. There's usually an attempt at a trend early in the day. It's important to know whether that trend is likely to continue for the entire session or the entire day, or are there characteristics of that trend that make it likely to end at some point after 2 or 3 hours and transition into a trading range or possibly an opposite trend. At the open of a session, there's often a strong move up or down. You should assume that any strong move on the open has a 50% chance of reversing. For example, strong seller, it reversed up. Strong rally, possibly reversing down, but looks like we're resuming up. This is the start of a bull trend. This is the start of a bull trend. Is it going to continue all day? Or will it evolve into a trading range? Or will it reverse? We have 3 bull bars here, one closing on its high, but none is very big. Here we have a very good bull bar and a follow-through bar, but the follow-through after that was weak. This is more likely to be a bull leg and what will end up as a trading range day. Whenever I see a weak rally that looks like a bull leg in a trading range day, I also look for one other thing: gaps. I want to see if a pullback falls below the breakout point. If a pullback falls below support, like the top of a buy signal. If you have a weak rally and gaps, that increases the chances that it could be a small pullback bull trend day and it could last the entire session or even the entire day. Gap is important. And now we have 6 consecutive bull bars. Even though they're small, each one is closing at its midpoint or near the high. There's a gap between the low of this bar and the high of that bar, a gap between the low of this bar and the high of that bar. There's subtle strength going on here, and this might be much stronger than it looks. And this was the result, a small pullback bull trend day. Looks like a good rally. Climax, smaller bar, climax, smaller bar. Follow through, not all that good. We have a strong breakout, but look at this low. It fell below the breakout point. Look at this low. It held above the breakout point. Even though this day has bigger bull bars than this day and more bull bars than this day did initially, the gaps are closing. Another breakout, pullback below the breakout point. Breakout, immediately close. Breakout point, pullback below the breakout point. A breakout point, breakout, pullback below the breakout point. The gaps are all closing. That means bears selling above bars can make money. They sell at the prior high, sell more higher. Bears are making money. When the gaps are staying open, the bears cannot make money. A bear sells this high, sells more higher. It never gets below this high, so he could not get out break even on this first short right here, and he bought back his shorts probably for a loss. When it's very difficult for the bears to make money, there's a higher chance the market's going to go higher, because if the bears cannot make money, at some point they stop selling, and they don't want to sell until the market gets much higher, and the result is it's a very easy buy for the bulls. They buy knowing the bears will not sell, and you end up with a big trend day. Here, the bears are able to make money, or at least are able to avoid a loss. If they sell high, the market pulls back below the breakout point, and they can get out without a loss, or they can sell more higher and make money. If it's fairly easy for bears to make money, and fairly easy for bears to avoid a loss, the rally probably soon is going to transition into a trading range. The bulls are not buying strongly at prior highs. We broke to a new high and went up and it sold off. Bulls probably are taking profits above every prior high. That's not what typically happens in a trend that's going to last all day. The bears are getting confident that every new high is going to pull back below the breakout point, and they're hoping that this will end up as a bull leg in a trading range. In other words, that instead of continuing up all day or all session, it'll soon start to have a leg sideways to down. The strong initial rally ended and the market became a trading range. This was a bull leg in what became a trading range day. Most days have a trend in the open of the session, and traders have to decide whether they think the trend is going to last all day or if it will simply transition into a trading range or possibly reverse into an opposite trend. We have a weak sell-off on the open, lots of reversals, the absence of consecutive big bear bars closing on their lows. It looks like a bear leg in what will become a trading range day. However, look at the pullbacks. It pulled back for only a bar or two, pulled back for only a bar or two. Same here. Here it pulled back for an hour or so, so it looks like it's transitioning into a trading range. And then we're getting a bear breakout. Even though this pulled back for an hour or two, it only overlapped this breakout point. Here's a breakout right here. It overlapped the breakout point, well, only by a pip or two. So no gap. But when there's only a tiny amount of overlap, I think of it as having properties of a gap, and I call it a negative gap. And at this point, we have an actual gap. This reversal attempt has not yet gone above the breakout point. We see a weak sell-off. It looks like a bear leg in what will become a trading range day, but we have a negative gap. And now, at this point, we have an actual gap. Therefore, traders have to be thinking that this could be the start of a small pullback bear trend day, which is a relentless bear trend day. When you get gaps like this, it means the bulls cannot make money. If they buy at that low, it did not fall far enough for them to add on. It did not get back above this low, which would allow them to get out with a profit or to avoid a loss. If this gap stays open, that means the bulls are losing money. And if the bulls are losing money, it's probably not going to be transitioning into a trading range anytime soon. And we already know the pullbacks are small. We know that it looks like a weak sell-off. And now if you add the third component, gaps and negative gaps, you have to be thinking this could be a small pullback bear trend day, which is the strongest type of trend day, and it can last for the entire session or for the entire day. And that's what happened. At some point, the bulls decided they cannot make money, so they stopped looking to buy, and the market trends relentlessly down for the remainder of the session. Lots of big bear bars on the open. More here, more here. Good for the bears. But there are also a lot of big bull bars closing on their highs. When you see a bear trend that has a lot of big bull bars closing on their highs, usually the bear trend will not last for the entire session. Usually the sell-off is a bear leg in what will become a trading range or a reversal. Pullbacks lasting 5 or 10 bars. Pullbacks here lasting 1 or 2 bars, 2 or 3 bars. A breakout to a new low immediately reverses. Breakout to a new low, strong breakout, immediately reverses. New low reverses. Breakout to a new low, strong breakout, but reverses. That means that bulls who bought at prior lows can avoid a loss, or they can make money. They buy the new low, buy more lower. It gets back above their first entry. They can make a profit. If it's fairly easy for bulls to make money in a bear trend, and the pullbacks are lasting 5 or 10 bars, and there are a lot of bull bars, and all the gaps are closing, this is probably not going to last for the entire session or the entire day. We're probably going to get a reversal into a bull trend, or the selling will stop and we'll simply enter a trading range. This is therefore either going to be a bear leg in a trading range. Possibly it could remain a broad bear channel all day, but those happen only about once a month or so. And it ended up evolving into a trading range. So bear trend, but the gap's not remaining open. Bulls able to make money. You have to assume the market is going to stop being a bear trend and become either a trading range or a bull trend. We have a wedge bottom, pretty good reversal up, higher low trend reversal, but at the end of the session, we do not know if it's going to reverse up into a bull trend. 5-minute chart, euro versus the dollar. European session, US session. This is still the European session here as well. At the start of the European session, first hour or two or three, traders are looking for a trend up or down. And that's true with the American session as well. If the market begins with a trading range, traders expect a breakout up or down and possibly a swing up or a swing down. Because of that, traders are looking for a sign that the trading range is ending and that a trend is beginning. Here, bull bar closing on its high. Here, a pair of bull bars closing on their high. We don't know at this point if this is going to be a bull trend or if it's going to have a deep pullback and will remain a trading range. In either case, bulls will buy at the top, put a stop below. If it keeps going up, they make money. If it goes down, they buy more, betting on a trading range. Then they can get out break even on their first entry and with a small profit on their second entry. Here we got a deep pullback. Here we did not. It just kept going up. If you take this buy, we're trying to break out from a trading range. You have several choices for a stop. For example, the bottom of where it began to accelerate up, maybe below this higher low, maybe below the bottom of the entire bull trend. All are reasonable. If you take the tighter stop, you're going to lose more often, but you'll lose fewer pips. If you use the wider stop, you'll lose less frequently, but when you do lose, your loss will be bigger. All three are reasonable choices. If you take 100 trades and you trade with tighter stops, and somebody else takes 100 trades and they trade with wider stops, the profit will be about the same for both of you, as long as the stops are reasonable. We got a breakout. We have a pullback. A lot of bear bars in a tight channel. The first reversal up probably will be minor. The bulls will probably need a double bottom. However, we're always in long, and bulls will buy reversals up from pullbacks. Here, 2 legs down, 1 pullback, 2, a double bottom higher low, a reversal bar, buy on a stop above the high. Strong breakout, a 1-bar pullback, bulls will buy above the high, looking for resumption up. 3 bear bars, and then a bull bar closing on its high. Bulls will buy here, above here, or above here. When the day is going to end up as mostly a trading range, you'll see pullbacks breaking below support, like the bottom of the buy climax. If you see a pullback below the bottom of the buy climax, you have to assume the day is probably not going to be a strong bull trend day. It'll either be a trading range day or a weak bull trend, as it was here. Obviously, if the reversal continued down, it could become a bear trend. But at this point, it's probably going to be mostly a trading range. If a trader did use the tight stop, let's say right below the bottom of the 2-bar buy climax, and he gets stopped out, and the market looks like it's reversing up, he'll buy again above a bull bar, betting that it's a failed breakout and probably a trading range. Breakout, we have consecutive bull bars here. We have 5 or 6 bars without a pullback. Reasonably good breakout, likely to lead to higher prices. When you have a strong breakout like this, the market is going to go up to some resistance level. And traders should look for resistance because that's where bulls will take profits. Bears might start to sell. When the leg up is this strong, the first reversal down is probably minor. leading to either a trading range or a bull flag. You have to assume there'll be a second leg up. Pull back below the breakout point, but very little, so I think of this as a negative gap, and that's a sign of strong bulls. The bears were unable to overlap the breakout point very much, and they were unable to overlap this breakout point or this breakout point at all. Therefore, this is probably going to continue higher. The first thing traders should look for is a measured move. Several different possibilities, one based upon the height of the trading range, another based upon the height of the breakout, the open of the first bar to the close of the final bar, or the open of this bar to the close of that bar, potentially a measured move up. Maybe a measured move up based upon the height of the entire leg. Here we got a negative gap, pull back slightly below this breakout point, and therefore possibly a measuring gap. This is a measured move up based upon the height of the trading range, and you can see a pause. Bulls were taking profits, at least partial profits, but not aggressive profit taking. The profit taking was brief, and the bull trend resumed up again. Strong enough breakout for a second leg up, and therefore every time the market tries to reverse, the bulls expect the reversal to be a bull flag, and they'll buy above the high of the prior bar, looking for a resumption of the bull trend. So they'll buy here, they'll buy here. Strong enough breakout here, probably at least a small second leg up, and possibly a measured move up based upon the height of the breakout. The European session ended with a trading range, and then the US session had a strong breakout. 3 big bull bars closing above their midpoints, 2 of them closing on their highs, and this bar is getting bigger, so the market is accelerating up. Consecutive buy climaxes at the start of the US session, but remember, no matter how strong a breakout is on the open of a session, there's a 50% chance it's going to reverse. At this point, there's a 60% chance the market's going to go up for a measured move, but if it starts to get bear bars, then 50% chance it'll reverse. Three pushes up and down, another breakout, and then pause, and then the third breakout, possibly a parabolic wedge rally. And if so, we could have an early high of the day, and then a pullback that just keeps growing and growing and growing into an endless pullback, and then breaking to the downside into a bear trend, taking us all the way back to the bottom of the parabolic wedge. As strong as that initial rally was, look what followed. A strong bear bar closing on its low. When I see that on the open of a session, I always get out below that bear bar. A big bear bar closing on its low after a strong rally, and very often I'll sell, looking for at least a scalp down. Usually you get 2 legs sideways to down. 1 pullback 2, yet we had multiple other legs and it was a triangle. The bulls got trend resumption up, back to the high close, and that was it. The bulls who bought this close bought more lower. They were so disappointed by what followed, they were happy to get out when the market got back to their high close. This is bull selling. Reasonable to buy closes in a strong bull trend because you expect the market either to continue up in a bull trend and you can make money, or you expect the first reversal down to be minor. Even if it's strong and deep, a trading range is more likely than a bear trend, and therefore the bulls who buy here can buy more lower, expecting the market to get back to this close. If at this close there was a micro double top, then the bulls would have had an opportunity to get out without a loss or with only a small loss, and that is more likely to lead to a trend reversal. However, if you have no opportunity to get out avoiding a loss, then the rally was very strong and the reversal down is probably minor, and you're either going to get a bull flag and immediate trend resumption up, or a bear leg in a trading range, and then eventually get back up to that high close, and you'll be able to get out without a loss. Many reversals, lots of overlap, strong bull bars, strong bear bars, prominent tails. It's a trading range. It's a limit order market. Most traders should not trade here, or they could buy expecting the market to get back up to this close where the buy the close bulls got their final buy. They never had a chance to get out break even. 70% chance we're going to get back there and they'll be able to avoid a loss. And if they buy more lower, they'll be able to make a profit. Strong bull trend on the open and now a triangle in the middle of the day. Triangles late in a bull trend usually are the final flag, and that means that if you get a breakout, we're probably not going to get a bull trend. The breakout will probably fail and return back into that final bull flag. And then either you can get a reversal or simply remain sideways. You can see when we get up to that high close, the market stalled. The bulls are deciding, is this strong enough to lead to a bull trend, or is it better that we just get out of our longs? The bulls who buy here are taking profits. The bulls who bought here are getting out, avoiding a loss. You can see this hesitation. Is it going to continue up, or are the bulls giving up? Here, two big bear bars closing on or near their lows. The bulls are giving up. We'll probably get at least a couple legs down. The market's always in short. Bears will sell closes, expecting that either this is the start of a trading range, in which case, if it goes up, it'll come back down and they can avoid a loss, or it's the start of a bear trend, in which case they sell and they can make money. 5-minute chart, euro versus the dollar. Strong bear trend and then abrupt reversal. V bottoms are rare. So the first reversal up is probably minor. Even if it's strong, the first reversal up is going to be either a bear flag, it tried to be here, was not, or a bull leg in what will become a trading range. You can see it retraced most of the sell-off, and therefore it's probably a bull leg in what will end up as a trading range. Also, look at the rally. The pullback from this breakout fell below the breakout point. We broke to the upside trying to get a gap, but it fell below the breakout point. This is probably a bull leg in what will become a trading range. Big down, big up, big confusion usually results in a trading range. Strong rally, but look to the left. It's still below the top of the bear trend, and therefore this is more likely a bull leg in what will become a trading range than the start of a bull trend. Also, there was no major reversal, no big wedge, no higher low or lower low or double bottom major trend reversal. Bulls are trying to break above the top of the channel and it's reversing down. They're trying to break above the top of the sell climax and reversing down. If you want, you can call this a parabolic wedge. It's a tight channel with 3 or more pushes, 1 pullback, 2 pullback, 3 pullback, 4. Strong sell-off, probably bull leg in a trading range. And if it's a trading range, you have to expect another leg down. We sold off, bull leg in a trading range. Well, bull leg in a trading range is usually followed by a bear leg in a trading range. Strong sell-off at the start of the U.S. session, rally up for a couple of hours, but probably going to be a trading range day. Five-minute chart, euro versus the dollar. We're getting a breakout, a reversal, down and up early in the day. Did the U.S. session begin here? Maybe. Right? Did the U.S. session begin here? 5 o'clock Pacific time? Maybe, a little bit early. Strong sell climax, pretty good reversal up at this point. This is probably the start of the U.S. session. This is probably when traders are believing a trend is underway. The market tried to sell off, tried to rally, tried to sell off, and now is going up again. We have a reversal up, a reversal down to a new low, and we're breaking above the top of that reversal down. This is one of those breakout mode patterns that I talk about on the open. Once it breaks above the top of the reversal down, we're probably going sideways to up, which we did. Strong breakout, terrible follow through. Very deep pullback, reversing the entire bull breakout bar, but holding above the bottom of the range. Remember, early in the day, we have a reversal down and a reversal up, and then we broke out of that range. The market is probably not going back below this low. It's probably going to remain a trading range day or possibly have a bull trend. But look what followed the breakout. Several bear bars and then lots of dojis. If we do get a rally here, it's probably not going to be a strong bull trend. It's probably going to be a bull leg in a trading range. And it was. It rallied up for 5 hours, 4 or 5 hours, and then sold off late in the session. Middle of the session, the market went sideways, never strongly up. 1 bar bad follow through, 1 bar bad follow through, 3 bull bars, all small, prominent tails. This does not look like it's going to be a strong bull trend day. We're getting overlap, pullback below breakout points. If you see a rally and you think it does not look like a bull trend, then you have to assume that it's probably a bull leg and a trading range day, and therefore it'll either evolve into a trading range or have a bear leg. So you have to be prepared for a reversal down late in the session. Look to the left, we're trying to break above prior highs, trying again to break above prior highs. Both attempts fail, so probably we'll have to go the other way. You can see this is around 11 o'clock. Therefore, this is probably some kind of a news event like an FOMC announcement. Normally around 11 o'clock, Forex markets become very quiet, 11 o'clock Pacific time. But here we have pretty good bull bars, a bear bar. This is probably an announcement from the American Federal Reserve Bank. The market was in a bull channel, trying to break out of the top, and it reversed down. Usually, you do not get a tradable swing at the end of the session. Usually, it's a tight trading range. 5-minute chart, euro versus the dollar. The market is rallying, but every pullback is falling below breakout points, so it's a fairly broad bull channel. There's an absence of consecutive big bull bars, small bull bar, doji, and it keeps reversing down. Whenever you have a rally that looks weak and it looks like a bull leg in a trading range, you have to be looking for reversals. Here we have a buy climax to the top of the channel, a bear bar closing on its low. Some traders will sell below that low, betting that the second half of the session will be a swing down. Others will wait for 3 or more bear bars and then start to sell. And you can see we got a reversal in the middle of the session. Again, most days on the daily chart have a tail on the top or the bottom. And if you have a tail on the top of the bar on the daily chart, it comes from a rally that reverses. If you see a rally that looks weak, look for a reversal because most days have a reversal, most days have a tail on top. Some traders will sell on a stop below that bear bar. Higher probability to wait until you see 3 or more consecutive bear bars and then sell closes or sell above bars. Here we have 3 bear bars and a pause. Some traders will sell on a stop below that bar. Now we have 5 or 6 bars down. Some traders will sell with a limit order at the high of the prior bar, expecting at least a small second leg down. For any of these sells, I would put a stop above the top of that strong bear reversal bar, especially since it's at the top of a channel. If you get stopped out and it reverses again, traders will sell again, expecting a swing down. Higher probability to sell after you see a strong reversal down, 3 or more bear bars. And then you can sell for any reason. You can sell closes. You can sell above bars, betting reversals will fail. You can sell bear breakouts, betting that there'll be follow through even if there's a deep pullback. We have what looks like a bull leg in a trading range. That word trading range is important. That means if we get a sell-off, it'll probably be a bear leg in a trading range. And if this sell-off is going to be a bear leg in a trading range, it's probably not going to fall much below the low of the bull leg, if at all. And here it did not fall below. And therefore, it's good to diagnose early because it's unlikely to fall 100 pips. It's probably more likely to fall 20 or 30 or 40 pips. And the earlier you enter, the more potential reward you have. 5-minute chart, euro versus the dollar. Does this look like a strong bear trend? Well, we have some strong selling. However, it's not all that strong. Doji's bull bar, another bull bar closing on its high, another reversal attempt, maybe a small expanding triangle. Up, down, up, down. This does not look like a bear trend that's going to last all day. Traders will start looking for a reversal. If the sell-off looks like a bear leg in what will become a trading range, traders expect the market either to go sideways or to have a bull leg in that trading range, and therefore they're going to look for reversals. Consecutive bull bars reversing much of this sell-off. Some traders will start to buy closes, or they'll start to buy above bars, above even a bear bar. Higher probability to buy above a bull bar. We have a small double bottom starting to reverse up. Traders will put their stop below the bottom. If the market falls below their stop, they get stopped out. If it reverses up again, they'll buy again. Some traders will even buy and use a wider stop just in case it goes down a little bit more. They want to make sure they do not get stopped out. They'll buy more lower. Bulls are looking for a give-up bar. They want some sign that the bears are giving up. Here are a couple of attempts at a give-up bar, but the bears did not give up. Here, and then here, somewhere in here, the bears are giving up, and this is where the final bears gave up. Strong pair of bull bars closing on their highs, breaking above the top of a 3-hour trading range. Buying down here, when the market's still in a fairly tight bear channel, is a lower probability buy, but lower risk. If you wait until there's a strong breakout, here are 3 consecutive bull bars closing on their highs, the probability is higher that the market will continue up, but the risk is greater. Both are acceptable ways to trade. Because a trading range is more likely than a big bull trend, the profit potential is not that great, and it's a higher reward potential if you enter early. Most sessions begin with a trend up or down. You have to look for features within that trend to determine whether it looks like it'll be a trend that'll last for the entire session or the remainder of the day, or will it transition into a trading range or possibly an opposite trend. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 3 videos on trading in the middle and at the end of the day.